Let's talk about going from sole proprietor to S Corp. What are the tax implications? Here is the approach I want you to pay attention to. So when we talk about switching from sole prop to S Corp, there's basically you have a pretty straightforward sort of process. Okay, for many small business owners, entrepreneurship is really sort of a little adventurous, rewarding, and at times utterly confusing. So the thing here is that when we talk about S corporation, you need to understand you have a specific case here. Okay, so when we talk about S corporation, one thing I want you to pay attention to, first of all, there are 5 main entity types. So S corporations are just one of them. So you have sole proprietorship, you have partnership, you have limited liability company, you have S corporation or S Corp, and you have C corporation or C Corp. So your entity choice or type of business has a direct impact on how you are taxed, what degree of liability you're exposed to, who your owners can be, and more. So each entity type has its pros and cons, so you want to think carefully about your options here. And you also need to think about your tax status. So first you think about your entity choice, but also your tax status. So how an entity is taxed is one of the chief drivers of decisions on entity types. S corporations, for example, are often considered a smart choice because of the tax benefits they actually offer. Self-employed individuals, such as the sole proprietors, generally must pay self-employment tax as well as income tax at their federal individual tax rate, just like before they started the business. And they report their income and expenses on their personal tax returns instead of on a separate business tax return like a corporation would. And S corporations don't pay corporate income taxes. Instead, they are treated as pass-through entities, which means what? Earnings from the business will pass through to be included on the owner's personal income tax return. So S corporation will file something called Form 1120S. Now, when we talk about S Corp, subchapter S corporations, aka S Corps, operate under a special designation of the tax code. The S corporation provides its owners with limited liability and flow-through tax status, allowing them to avoid double taxation. Okay. Now, it's important to remember that S corporation status is a tax status that a business elects by filing IRS Form 2553. That means the owners must first create a corporation or a limited liability company and then choose to be taxed as an S corporation by submitting the form to the IRS. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Let me give you a few pro tips here. So how to know when an S Corp is right for your business. So there are a few key indications that should cause a sole proprietor to consider an S corporation status. If at least 2 of the following points are of high interest to you, an S corporation will probably be the way to go. We're going to put some of those on the screen. If you want to protect your personal assets, if you want to draw a salary, if you want flexible ownership, if you want accounting to be easy, if you want to avoid double taxation, you basically will be interested in an S corporation. At least 2 of those 5 reasons will actually qualify you for an S corporation, or at least will trigger the interest of an S corporation in your business ventures. Let me repeat them. You want to protect your personal assets. You want to draw a salary. You want flexible ownership. You want accounting to be easy, and you want to avoid double taxation. Let's go a little granular here. So you want to protect your personal assets, right? Many different entity types offer personal liability protection, and S corporations are chief among them. The bonus is S corporations have other benefits too. So you want to draw a salary. So if you are a business owner who wants to take a salary as a tax deductible expense, then an S corporation is the way to go. S corporation rules require owners to pay themselves reasonable compensation, and your salary helps comply with those rules. You want flexible ownership. Interest in an S corporation can be transferred without triggering adverse tax consequences. In a partnership or LLC, the transfer must actually comply with a lot of things, because if you transfer more than 50% interest, this can trigger the termination of the entity. Also, an S corporation does not need to make adjustments to the property basis or comply with complicated accounting rules when an ownership interest is transferred. You want accounting to be easy, so corporations must use the accrual method of accounting unless they are considered to be small corporations. S corporations, however, usually don't have to use the accrual method unless they have inventory. or you want to avoid double taxation. So corporations are great for protecting assets, but they're not so great for taxes. C corporations must pay taxes on their profits, and their shareholders pay tax on dividends or other distributions they receive. By electing S corporation status, any dividends or distributions will only be taxed once at the shareholder level. Boss, I want to quickly remind you of today's topic. We are having a conversation about transitioning from a sole proprietor to S corporation. What are the tax implications? Let's talk about the steps you need to really pay attention to here. How do you convert from a sole prop to an S Corp? So if your business is operating as sole proprietorship and you are a U.S. citizen or equivalent, converting into an S corporation is relatively simple. Step number 1, you want to establish a single member limited liability company. So SM LLC, assuming that you haven't already done so. So this LLC will be your legal entity structure. So forming an LLC is also relatively simple, but keep in mind that every state will have its own set of rules. In general, there are 3 steps to creating an LLC. So get your paperwork in order. So this typically consists of your articles of incorporation, aka certification of formation or certification of organization. This has the basic information of your LLC, its business name, member, you, of course, and who your registered agent is. The operating agreement, the document that states how the LLC is run, along with other bylaws, roles, and responsibilities of the member, again, you. Second thing is you need to register with the state, with the Secretary of State. So you should name and register your business with the Secretary of State, where it will be domiciled. As a single member LLC, you can use your Social Security number for tax filings, or you can apply for an employer identification number, your EIN. The third leg of step number 1 is you need to apply for licenses and permits. So depending on your business, it may be necessary to apply for licenses or permits to operate it legally. Check with your city and county governments to find out what the requirements are. Now, an attorney can help you with these items, but if your business will be pretty basic, completing them shouldn't be very difficult. So step number 2, you want to file IRS Form 2553. So this is basically you need to convert your single member LLC to an S corporation. There are 4 sections to a Form 2553, but most small businesses really only need to worry about one of them. Part 1, election information. Part 2, selection of fiscal year. Part 3, qualified subchapter S trust QST. Part 4, late corporate classification election. So if you file IRS Form 2553 by the relevant deadline, then you can skip this section. Let me give you a bonus here. So there are some tax advantages to S corporations. There are a few of them. So there are a few tax advantages to convert into an S corporation. First, because of the owner of an S corporation is required to pay themselves a reasonable salary, the business can deduct this expense for bookkeeping and tax purposes. Likewise, an S corporation must withhold and pay its share of FICA payroll taxes. Those are deductible expenses too. And those expenses reduce your S corporation's overall profit, which in turn reduces its owner's taxable income. Pretty great, right? And what's even better is that by converting your company, your sole proprietor to an S corporation, a business owner can avoid the 15.3% self-employment tax. So your sole prop, even if it's organized as an LLC, cannot do that. So these are just a few of the S Corp tax advantages, but it's one of those things where you have to really see what really works for you. One thing I want to say here is that it's all about how you actually analyze your situation. Let me give you an example here. Here is a simple example to help illustrate the tax savings here. Let's say a sole proprietor, we're going to put this on the screen so we have a clear idea what we're talking about. So sole proprietor, 100 grand. So for revenue, expenses 30 grand and 35 grand for S corporation, because the salary you paid yourself. Okay. So the salary is actually 40 grand if you have an S corporation. No payroll tax and feudal tax for sole proprietorship, but for S corporation, you are paying some FICA tax and some feudal tax. And basically here, the net income for the sole proprietor is $70,000, but for S corporation, we have $21,520. You can see right off the bat that the S corporation really reduces your taxes a lot. So your portion of payroll taxes here for the sole proprietorship or LLC is about 10 grand. But for the S corporation, it's about 3 grand. Think about that. 30%, like 70% less. So the total payroll taxes paid is 10 grand for the sole proprietorship and $6,500 if you are having an S corporation. So payroll tax savings here, we're speaking about $3,300. So this is really cool. I mean, when you really think about it, we can explain even further, but whether your sole proprietorship is relatively new or well established, in many cases, converting to an S corporation has too many benefits to ignore. By the way, boss, welcome back. I want to really remind you of today's topic. We are having a conversation about going from sole proprietor to S corporation. What are the tax implications? Let me give you the approach you need to really pay attention to when we talk about doing taxes when you switch to an S corporation mid-year, okay? So if you're a small business owner, switching to an S corporation can make sense for many reasons. I've just given you some of them. And so what happens here is that, if you can actually do it mid-year, that's really cool. So when you make the switch, when you switch to an S corporation, also known as subchapter S, you can choose the date the S corporation election takes effect. So from a taxpayer perspective, switching on January 1st is popular for simplicity's sake. With this date selected, you can close last year's books for your sole proprietorship and start new ones for your LLC taxed as an S corporation using the full year for tax purposes, right? Now, a mid-year switch means a bit more work, but it's more manageable and sometimes worth the effort. So if you're considering switching to an S corporation, it's already November, December, you might want to wait. However, early in the year, an immediate switch won't cause too many headaches and will be worth the savings. So when we talk about switching mid-year, if you choose to do that, there are a few things you need to do. You need to set up a legal structure and file the S election. So before you actually can elect for S corporation taxation, you'll need to have a legal structure in place. So this could be an LLC or a corporation. A sole proprietorship cannot elect for S corporation taxation. So this is an important step in the process. So 2553, I just spoke about that. And then you need to get a new bank account. So if you're running a sole proprietorship, you might be using your personal bank account to manage your business finances. Once your legal entity is established, you will need to open a new bank account under the business's name and EIN. Open a new business bank account and update all your business transactions, including payments from your customers and expenses your business pays, to go through this new account. You might also want to open a business credit card. So when opening your business bank account, using a different financial institution can help you keep your personal and business funds separate. However, you could also use your current bank and simply open a new account. It's up to you to decide which is easier. And then you want to pay attention also to record keeping, okay? You'll need to change your bookkeeping once you make the switch to abide by the IRS codes. You can do this by starting new books and separating your company's finances from your personal ones. That means you'll have one set of records that tracks your sole proprietorship's finances up to the date your new entity formation, and a second set of records that track your S corporation's finances from that day until the end of the year. And so when it comes to time to file your taxes, you'll put the information in the sole proprietorship's books on some forms and information from the S corporation's books on others. Let's talk about filing taxes as a sole proprietor. So when you file your taxes as a sole proprietor, you must pay regular income taxes and self-employment taxes. Very important. This means what? It means filing Form 1040 for your individual income taxes, Schedule C for your profit or loss from your business, and Schedule SC for your self-employment taxes. And so sole proprietorships are a pass-through entity, so we don't have a double taxation here. This means what? That all income for sole proprietors flows through to your personal income tax return. So you will report all your earnings on your personal income taxes. You will also pay a higher tax rate since you are responsible for the 15.3 self-employment SE tax on all your earnings as a sole proprietor. And the self-employment tax includes Social Security and Medicare taxes, sometimes called payroll taxes. Let's talk about filing taxes as an S corporation. So unlike sole proprietorships, S corporations have their own corporate tax filing requirements. So when you file taxes for your new business entity, what happens here is that you will file Form 1120S and Schedule K1 to detail distributions made to your S corporation shareholders. And there may be also some state filing requirements. So you want to really talk to your state authorities, state tax authorities, to know more about that. Or just let us know in the comment section and we'll get back to you. Let me give you an example. Massachusetts uses Form 355S, Schedules S and Schedule SK1 for S corporations. And it's important to look up any requirements your state has by reviewing your state's tax website. If you're not really sure whether you're looking at your state's tax website, make sure that you make sure the URL ends in .gov, okay? And one key consideration for S corporations is that they have a different business tax filing due date than individuals. So typically, S corporations must file taxes with the IRS by March 15th if the S corporation is a calendar year taxpayer, 1 month before the individual tax filing deadline. And your S corporation also has to issue tax forms such as W-2s, which report the wages you received from your S corporation and the taxes from your paychecks. You also include here the information from your W-2 when filing your personal income taxes. And one thing I want to say before closing here is that once you file your S corporation taxes, you can focus on filing your individual tax return. And so like with a sole proprietorship, you will file Form 1040 of your income. You also file a Schedule E with information from K1 for supplemental income and loss. And you may also file Form 1040ES if you paid estimated taxes. Let me give you an example here, okay? Let's say, because I really want to really break it down for you so you have a clear idea what I'm talking about. Let's say John Doe is a marketing consultant and operates as a sole proprietor, and he decides to actually switch to an S corporation, let's say halfway through the year, and opts to have like July 1st to be the effective date for the switch. Okay, so far so good. And so John consistently earned 10 grand per month, so $10,000. And this amount at the end of the year, basically he made a total of 60 grand while operating as a sole proprietor and 60 grand while operating as an S corporation. So he follows tax law by taking 30 grand as a reasonable salary, then takes 30 grand as distributions. So step number one here, in this example here, you need to file S corporation tax return. So when preparing his taxes, John must first handle his new S corporation to meet the required tax deadlines. This means issuing a W-2 for the wages he paid to himself. He must file his S corporation's forms by the March 15th deadline. This includes Form 1120S and Schedule K1. He will also file any state tax forms. That's step number one. Step number two, you need to report S corporation earnings on personal tax return. So once John finishes his S corporation taxes, he can file his personal tax return by April 15th. He will fill out Form 1040, detailing his earnings for the year, including the 30 grand in wages he paid himself and that his S corporation reported on his W-2. He will also fill out Schedule E, which details supplemental income and loss that describes the 30 grand in distributions he received from his S corporation. Remember that $30,000 in distributions will not be subject to 15.3 self-employment tax, saving John really $45.90 when he goes to pay taxes. This reduction in his tax liability is worth the extra effort. Step number 3 here. Report the sole proprietor earnings on personal tax return. So since he also operated as a sole proprietor for part of the year, John will also file Schedule C and Schedule SC. Those forms will report the 60 grand in taxable income he earned as a sole proprietor and the self-employment taxes he must pay. So ultimately, this means John files standard income tax forms for self-employed people that operate as sole proprietors, and income tax forms for an S corporation, all in the same year. However, in future years, John will not be required to file any sole proprietor tax forms. So bottom line here is what? Switching from a sole proprietorship to S corporation status mid-year does not mean slightly more tax filing requirements at the end of the year. You will need to file forms for your new business entity and sole proprietorship, but you will only have to do this for the current tax year. You want to have a sole proprietorship to file for in future years, meaning you can focus on S corporation tax forms. And despite the additional work, the savings and benefits an S corporation provides are worth it when you pay your federal income taxes. So this is kind of an interesting to think about. Thank you so much for your attention. I really appreciate it. In today's conversation, I talked to you about transitioning from sole proprietor to S corporation. So let me give you the recap here. I give you the approach, the pro tips, the steps, the bonus, the approach, and the second approach, and that's it. And then now the recap. Thank you so much. God bless you. I'll speak to you another time. But until then, remember, stay marvelous.